Hello, and thanks for joining me once again for part 2 of real estate investing for truck drivers. And you say, why just for truck drivers? Well, it's not just for truck drivers, but I am a truck driver, and I understand that we live a certain kind of life where you're on the road a lot and you're gone and you don't have time to be home and deal with things, such as owning physical real estate. Or maybe you just don't want to because you don't want to deal with placing tenants and maintenance and things like that. You just like a cleaner, easier thing to do. But I don't want you to think that just because you drive truck and you're on the road that you don't have opportunities available to you. There's just some that maybe you haven't heard of yet. So let's get started. Today we're going to talk about a company called Fundrise, Fundrise, I'm sorry. It's fundrise.com is their website. And what Fundrise is a company that they invest in real estate to put together all their own deals. It's kind of like a REIT, but it's well, you'll see in a minute how it's a little different. It's private equity. They're not publicly traded. So things like this used to only be available to what are called accredited investors, which would be the exceptionally wealthy people. But now, thanks to the technology and the internet, something like this is available to the common person. Minimum investment of $500. So it doesn't take all that much to get started. Now, what Fundrise is they're a company. They invest in real estate. They do projects. They build. They do rehabs. They raise capital for providing the financing for their own projects. So you can invest in the debt side of it, which would be mortgage-backed debt, and you can invest in the equity side of it, which is the property itself. You can invest in both. So you have those choices available to you. There's some upsides and downsides. Let's first talk about some of the downsides that are there. Some of the downsides. So this is more like investing in actual physical real estate than investing in REITs through the stock market is, because it is private equity. So you actually can invest in an identified property that the company owns, or you can invest in they have similar to a fund, which would put a little bit of your money in different projects, like I said, or you can invest in a specific property. So being that it's actual physical, tangible real estate, there's a lack of liquidity. It'd be similar to owning a rental property on your own. You can't just up and take your money out one day. You have to wait for that property to sell. So this is kind of similar to that. I wouldn't recommend it as a short-term investment. You want to commit your money for at least 5 years. Inside of 5 years, it can be a little bit more difficult to get your money out because, like I said, they have to find somebody to buy your position. They do offer to where they will cash you out at a reduced rate just for the sake of taking over your position. So there's that, a little bit of a lack of liquidity. But that's so in physical real estate also. The annual fees, they charge a 1% fee annually, and there can be some additional fees if they take on some kind of oddball investments or do some weird kind of sales. But overall, the general annual fee is 1%, which is you can make the case that that's kind of high, given that an S&P index fund would be less than 0.2%, but this is a different kind of investment. You gotta consider that, and what it's worth to you to have somebody else deal with all these things and do professional type deals on your behalf. It does pay dividends, and those dividends are taxed as ordinary income. Now, the thing about this is there could be a long-term sustainability issue in the growth. Okay, right now they're having great growth, but the bigger the company gets and the more projects they take on, it's a thing where that growth may slow down. Like say they're having 10 or 12% growth per year now. In coming years, who knows how long, 5, 10, 20 years it can take. As the company grows exponentially bigger, those rates of return may slow. But that's just how it works. You can't be a company a large cap company and grow at 10% a year. It doesn't happen. If you do the math, it just doesn't work out. So there is all that. Some of the upsides, it's clean and easy. I mean, you don't get your hands dirty. You let somebody else make these deals for you, and you just take part. You buy shares in properties that they own. Now, also, these people are highly trained professionals. They make good deals. They have a lot of money behind them. They raise a lot of money, and they can aggressively negotiate deals. And I've looked at their website at their strategies and such with the rehabs and where they're buying properties, and I pretty much agree with most of it. I think they do a great job on that. Another upside is it will allow you to invest in deals that, as an individual investor, just a small guy like me and you, it allows you to get into things that you would never otherwise ordinarily be able to get into. And I'll show you that here in a minute when we get that far into their website. It hasn't, $500 is not very much to contribute. You could never probably get into a rental property for $500. Your closing costs alone would be more than that. Yeah, you see on the late night infomercials, buying real estate with zero down. It's very risky, and a lot of it's a scam, and those deals are few and far between. I have done one deal like that in my life, but probably never happen again. So, that being said, let's flip the screen. Oh, and they do offer IRAs. The fee for an IRA is slightly higher. I forget off the top of my head what it is, but they do offer IRAs. Oh, and another downside I failed to mention, it could possibly complicate your income taxes slightly. You may receive an additional tax form called a K-1. So if you do your own taxes and you don't want to deal with that, maybe this isn't for you. If somebody does your taxes, it's just another form for them to file. It's not a huge deal. They'll know exactly what to do with it. You just need to keep good records like you always do for everything else. So let's flip the computer screen and jump into their website and take a look at what they got. All right, so here we are at the Fundrise homepage. It says, "Welcome to the future of real estate investing." Click here to get started. Built to help smart investors invest smarter. They have 130,000 investors, 4.9 billion in total assets under management, 79 million plus net dividends earned by investors, and historical average returns of 8.7 to 12.4%. So that's a pretty decent return. And take off your 1% annual fee, and it's still a pretty decent return on your investment. So now, smarter diversification. Like I said, it allows you to invest small amounts of money in several different properties at one time. Like I said, it also allows you to invest money in properties that, as an individual investor, you would otherwise not be able to do. So you can really invest in some high quality properties here. So you can start a starter investment is $1,000 or $500. I'm sorry, like I said, with a core position, you start with $1,000. You can diversify across dozens of projects and choose from 3 return profiles. So this would be the one where you could get into like a fund of their different properties. And then the advanced, the minimum investment is $10,000. You get everything in the core, plus the ability to diversify into specialized funds. So the more money you're willing to put in, the more investments you have available to you. So let's take a look at the historical performance of Fundrise. This is the performance of Fundrise investments net of fees. So average annualized returns: 2014, 12.25%; 2015, 12.42%; so on and so forth. 2019, 9.47%. And here it compares Fundrise income versus public investments. Here you got public bonds, public real estate, and Fundrise. So these are all, relatively conservative investments here, and they're comparing themselves to that. And this is just dividend yield. This is not total return. Now here's some of their assets. you can take a look at some of the different things you can invest in. It gives you credit rating of that particular deal area. Okay, so let's look right here. This is a stabilized commercial property in Alexandria, Virginia, right outside of Washington, D.C. They've committed $35,880,000 for it. And this was equity, which means you'd be buying a share of the physical property. They give you a projected return on it, 9.6 to 13.8%. And it's rated B3. So that's moderately risky portfolios, probably fairly safe. Let's see what else I got. New apartment development in Atlanta, single family rental home in LA. They have a lot of real estate exposure in Los Angeles, but they do it very smartly. A lot of it they're doing along the metro lines, which is those properties are just escalating in value. Single family, commercial renovation, new commercial development. They do commercial renovations, stabilized apartments in Las Vegas. I'd probably be inclined to stay away from that. In Las Vegas, real estate is all over the place. Here's a big old high-rise apartment. $30 million, credit rating C3. Now this is a debt investment, so you would be putting up money basically as a loan. It's not backed by equity, which would be ownership stake in the property. It'd just be on the debt side of it. So that's pretty neat. It's not my preference. Oh, I should say too, I do not have an account with Fundrise, but I intend to in the future. Once I tackle a current project I'm working on and knock that out, I'd like to very much have an account in Fundrise. So you can see, ooh, look at this. That's a pretty sharp looking building. Obviously it's just an artist rendering, but this is how the property is going to look. They're building this new commercial, looks like some kind of shopping center or something. Here's a new apartment complex they're building in Lake Stevens, Washington. I don't know where that is quite, but here's what it's going to look like when it's done. It's a D1 rating, $7 million. It's a debt project, 10.8% return. It's not something I'd be interested in. All right, here's something that I might be interested in. This is an apartment renovation in Hendersonville, Tennessee. It's got a B3 rating. It's an equity position, which I like. They're raising $7.2 million for the project. And projected return is 8.2 to 13.1%. Now this is the nice part about Fundrise is, say you live in Minnesota, well, you can still buy property in Fort Worth, Texas. Here's an apartment renovation. Brentwood, Maryland. Pinellas Park, Florida. So you can go all over the country and don't have to worry about managing your property. Some of these look very appealing to me, so others don't really. There's certain parts of the country I don't want anything to do with. I see a lot of Atlanta, Georgia here. Washington, D.C. is always a hot area, but a lot of Los Angeles, California. Here's just a single-family rental home they have in Arlington County, Virginia. $821,000. Wow. That's crazy. But you'll notice this, the safer the rating, the lower the return, which is, I'm absolutely okay with that. Like I said, I don't need to shoot for the stars. So let's click on here how it works. You select the account level and strategy that are right for you. It says whether you're a first-time investor or you've been investing in real estate for years, we have an account level that's right for you. Start with one of our most popular initial account levels like Core or Advanced, and then choose the investment strategy, income, balanced, or growth, that fits your personal goals. So you got 3 different investment styles to pick from. Or they can custom create a portfolio that's designed to meet your personal goals. As an investor, you earn returns based upon performance of the underlying real estate assets in your portfolio. Here you can click to learn more about their investment strategy. Let's look at how does Fundrise select its assets. It says carefully, to put it mildly. We make use of our extensive network, combined 100 plus years of experience, rich data, and intense underwriting process. We end up reviewing thousands of opportunities each year and select only the few gems that will power your portfolio. See, that's another advantage of something like this, is you could never do that on your own. You're pretty much limited to whatever's in your hometown or close by, if you can do it at all, being on the road all the time. Let's look at how do returns work at Fundrise. Real estate famously offers investors a unique mix of long-term appreciation and cash flow potential. Investing with Fundrise is no different. Fundrise investor portfolios have the potential to generate dividends on a quarterly basis, while their shares also grow in value over time. These returns ultimately come from the individual real estate assets in your portfolio, interest or rental income collected, as well as potential appreciation in the property's value. So you can kind of see it works pretty much like tangible real estate. Instead of a rent check, you're going to get a dividend check every quarter, or get the money deposited into your account, and then you're also going to get the capital appreciation. So anyway, I just basically wanted to introduce this to you, so you know that you in fact have options out there. I would encourage you to go to the website here, fundrise.com. Like I said, I do not have an account with them, but I intend to at some point. They're not a sponsor of this video or my channel. I do not get any money from them, and I'm not recommending them personally. I'm not recommending them in particular. There are other companies that work this way. You just do a Google search of private real estate investing, something like that, and find the one that works for you. This is probably just this is the one I know about. So I thought I would go through this one a little bit. This is probably the one I'm going to use when the time comes. So yeah, check it out. I hope you find this information useful, and we'll see you next time.